let's move on to chapter 12. This is profit or loss from business. This is specifically about Schedule C, sole proprietor businesses. We won't be covering partnerships or corporations in this part of the class. And before we go into the text itself, we want to talk about two important issues that come up whenever we're talking about self-employment. And that is, are you, or is someone who's working for you, an independent contractor or an employee? We talked about this a little bit in chapter 4 when we talked about wages, but we're going to reiterate all that information now. Because you might, there's a lot of people who pay their employees using 1099s, treating them as independent contractors, which isn't really appropriate. If you do receive like a 1099 NEC, which is non-employee compensation, that's what you would get as a contractor, and you believe that you should have been treated as an employee based on these rules, you can avoid filing Schedule C and file only an 8919 instead, which means you're only going to be liable for your half of the Social Security and Medicare tax, instead of self-employed people pay both halves of Social Security and Medicare tax. So there are 3 categories of rules that help determine whether someone is an independent contractor or an employee. And the 3 categories of rules are behavioral, financial, and kind of a catch-all category called type of relationship. No, not that. So the first category is behavioral control. This is basically the payer, the person who is paying the person who's working. One is the payer and one is the payee. That might be an employer-employee, or it could be a client-contractor relationship. It depends on how much control the payer has over the work that the payee is doing, or the worker. So our first subcategory for behavioral control, it would be types of instructions given. So the more control you exert over your workers, the more likely they are to be your employee. And this would be things like when and where to work, what tools or equipment you're allowed to use, whether you are allowed to hire other people to help do your work, where to go to buy your supplies and services, and whether work has to be performed by a specific person or not. So if I hire, like for example, if I hire a plumbing company, I don't care whether it's a specific person, I just need a plumber to come fix my issue. And then what order or sequence to follow, like do you have like a flow chart? So like I don't know anything about plumbing, so if I hire a plumber to fix my bathroom, I'm not going to tell them like step by step how to fix my bathroom, because I don't know, they're supposed to be the expert. So in that case, and things like that, if the payer is guiding all of these like specific steps, and you have to buy your equipment from our supplier, and you can only use equipment that we've purchased, that would be the kind of instructions you would give an employee. But if you say, get your equipment wherever you want to, use whatever you need to get the job done, I don't care how you do it, as long as it gets done, that would be more the type of instructions you would give a independent contractor, or lack of instructions. The degree of instruction would be things like how much detail your instructions are, how detailed your instructions are. So the more detailed the instructions, the more control the business exercises over the worker, and the more likely that worker is to be an employee. less detailed instructions means less control, and the more likely that the worker is an independent contractor.
Are we on a particular page?
No, this is from the IRS website. Two more ideas or concepts in behavioral control would be an evaluation system and training. So if there's like an in-house evaluation system, and if you do a bad job, you're going to get fired, you're probably an employee. But if the evaluation system is more like, if you do a bad job, you'll get a bad review on Google or Facebook, and people are less likely to hire you in the future. That's more likely to be an independent contractor. And the specific ideas they have here is, if your evaluation system measures each step of and the details of how the work was done, that's more the type of control you would exert over an employee. And if your evaluation only measures the end result, like, does my lawn look well cared for or not, I don't care whether it took you, what machines you used or whatever, it just, does it look good? Then that's the lack of control you would expect to exert over an independent contractor. And then finally, the degree of training that the company provides. If the business trains you on how to do your job, it's more likely that you're an employee of that business. And if the business hires you expecting you to already know how to do your job, that's more likely to point toward an independent contractor.
So the extent to which you don't know if they're going to stay on or if they are still in a training period, that doesn't have any effect on the classification?
No, it's more like if I have to teach you your job, that's likely to be an employee. Like if I hire you as a cook, and I say, okay, here's how you prepare chicken. You have to thaw it to this temperature, and then you have to cook it, and you have to check it with a thermometer, or whatever. If I have to teach you your job, I'm probably hiring an employee. But if I hire a cook and said, we just need, we need catering for 10 people, and we don't care how it's done, as long as it's done, I don't teach you anything about your job, I expect you to already know it, that's more likely to be a contractor. It could be a little bit different, like if it's like an apprentice type of relationship, but the more training you give to someone, the more likely they are to be your employee. And especially if training is ongoing throughout your business relationship. So if you were working for someone, let's say as a tax preparer, you would expect to continually train and improve and your job skills through your employer. Whereas if you were working for, let's say you were a bookkeeper for a construction company, the construction company is going to expect you to already know how to do your job. They're not going to teach you because their business is construction, not bookkeeping. Okay. The second category, again, this is to help determine whether someone is an employee or a contractor, is financial control. And financial control involves these subcategories. The first one being significant investment. Many lines of business or lines of work require some investment. whether it be training or buying tools or buying equipment, things like that. And if that initial investment is expected to be paid for by the company, that is more likely to be an employee relationship. But if that initial investment is expected to be paid for by the worker, then it's more likely to be an independent contractor relationship. So if I'm hiring a window cleaner for the office, and I expect that window cleaner to have their own equipment and provide their own supplies, that's more likely to be an independent contractor. But if I tell that window cleaner, okay, well, I'll buy, the ladders and squeegees and supplies and whatever, I expect you to use our stuff, that's more likely to be an employee. The next category is unreimbursed expenses. This is a little bit more murky, but independent contractors are more likely to have unreimbursed expenses than employees. Which includes like fixed ongoing costs. So if I'm expect you to provide your own supplies, I'm hired to clean my windows for, let's say, $50 to clean all the windows. I'm not going to also pay for your supplies. You just give me a quote, it costs $50, I say, okay, here's $50 when you're done. I'm not going to also pay for your supplies or your gas getting from your home to here or anything like that. I'm not going to reimburse you for your expenses. You'll probably build that cost into the price. That's different, but I'm not going to reimburse you. I'm not going to expect you to bill me for the amount of cleaning materials. This is a little bit murky because I know that a lot of businesses do bill for the supplies. Like for example, a paver might charge for the gravel that they bring in, or an attorney may separately bill for the court costs. If they have to file a document and it costs $25, that's going to show up on your bill. It's $25 in court costs, and they may charge you specifically for 25 cents a page for photocopy. So this is not a very strong category here. And this is still under financial control. The next category is opportunity for profit or loss, and that's an important factor. So if your worker has, they've invested in the tools and equipment for their business, they're not being reimbursed for their expenses, they might actually lose money at their job because they can't get enough clients. If I pay you $50 to clean the windows, you have to have quite a few clients to make a living off of that. And if you can't find enough clients, you lose money. If I somehow insulate you from the opportunity to lose money, so let's say you're working for me 20 hours a week, and regardless of how good our business is doing, you're going to make X dollars per hour and a certain amount per week, you have no opportunity to lose money. So even if the business loses money, you still make your wages. And on the flip side, you also don't, if you don't have an opportunity for loss, you often also don't have an opportunity for profit. So even if we have, even if the business makes a lot more than expected, you're still going to get paid your hourly. Maybe we'll get an extra bonus, but if I'm charging $50 per office to clean their windows, and I get a whole bunch of customers, I could make $100,000 doing that, or I could make $10,000 doing that, just depending on how many clients I have. The next one is, do you make your services available to the market? Which means, do you have more clients, or do you work for more people than just that one company that you're working for? Or do you have multiple or very many clients? So for example, we're a tax preparation company and we have thousands of customers. So because we make our services available to those thousands of customers, we are not that person's or those payers' employees. So even if you're off on your own, you know, as a solo tax preparer, you would offer your services to anybody that wants their taxes done. So you could have hundreds up to thousands of clients yourself, and that would make you more likely to be an independent contractor.
What would someone that's like a financial advisor generally be if they are working in a way through a brokerage, but they probably are getting paid basically on commissions, and I guess for some reason it just seemed like they're building their own book of business of clients. Are they usually treated as?
I think most of the time those would be independent contractors.
Even though they get set up through a brokerage or through something almost like a realtor would.
Right.
They're generally considered independent.
Yes, because they seek their own clients and are paid by their own clients through commissions or annual fees.
Okay. Even if they're selling a specific product line, or what if they're paid through the brokerage, their commissions?
If they're paid through the brokerage, they're more likely to be the brokerage's employees.
Okay.
Okay, so this question is, are you working for one company or are you working for several, could be dozens or hundreds of different companies? The more different companies you work for, the more likely you are to be an independent contractor of all those companies. So if you're working, so I talked about you working on your own as a tax preparer. If you're working for us as a tax preparer, we would be responsible for bringing in the clients and doing most of the advertising. You know, you could help out, but it's not, you're not going to be going around, you know, to people's houses and doing taxes at their homes. They're going to be coming into the office. So your services are really only available to us as your employers, and we would use your services to do taxes for the general public. And then finally, the method of payment. This is, again, not a very strong factor because, well, in general, employees normally get a regular wage, whether it's an hourly amount or weekly or a monthly amount. It could be a salary or it could be an hourly wage. And if you pay someone on that basis, a certain number of dollars per hour, they're more likely to be an employee. That's not very strong because many professionals also charge by the hour. So an attorney might charge $220 per hour, and they might charge, paralegal might charge $125 an hour. An accountant might charge $200 per hour, and a bookkeeper might charge $80 to $120 per hour. But it's just because it's per hour doesn't necessarily mean that they're an employee. But typically employees are paid per hour, and contractors are paid some other way. So it would be maybe per job, or maybe they have a quote, so that maybe they come up with an estimate or a bid, and they won't go over the bid, or maybe they are limited to going up to a certain percentage over the bid. But that is a factor. It's not a very strong factor. So that's all financial control. Our third category is kind of a catch-all category. This is kind of everything else that didn't fit in the previous two. And these are, one, your written contracts. So this is your perception between the worker and the payer. And if the contract says you're an employee, or if the contract says you're an independent contractor, that's going to hold some weight. It's not going to be 100% proof, but it's going to hold some weight. If everything else was kind of balanced, this could tip the balance toward one or the other. The next one is employee benefits. There are certain benefits that you normally only provide to employees, like paid time off or pensions, health care. Those are the kind of things you provide to your employees. So normally you wouldn't give those to an independent contractor. So that is another type of relationship. What is it called? Type of relationship factor. The next one is permanency of the relationship. If I'm paying someone to like pave my driveway, then once the driveway is paved, I'm done. I mean, I don't expect to see them again, unless I have a different job I need. So that relationship is non-permanent. It only lasts for as long as the job takes. So if the relationship is non-permanent, is expected to end when the job ends, that is more like a contractor type of relationship. Even though I might hire that same person back, maybe I'm a real estate investor, and so I hire the same people to pave multiple driveways. But we're done after each job. But if you expect to stay working for me after the job is done, and I'm supposed to come up with something else for you to do to fill your time, that's something more like what an employee-employer relationship looks like. And then finally, this is an interesting one. This is if the services provided by the worker are a key activity of the business, then it's more likely that worker is an employee. What does this mean? This means if you are a law office and you hire a lawyer, doing law, writing contracts, litigating, that's all a key activity of your business. And so those people you hire are more likely to be employees than if you hired an accountant to work for your law firm. So you might hire an accountant to maybe for a specific case where you need to research and figure out where all the missing money is in someone's books. So you might hire someone for that purpose. That'd be more like an independent contractor type of relationship. On the other hand, if you were a tax preparation company and you hired people to do taxes, then those people are more likely to be employees than independent contractors. If you're a tax preparation company and you hire people to wash windows, those are more likely to be independent contractors. So if the services provided by the worker are a key activity of the business, it's more likely those workers are employees. Okay, does all that make sense?
How would someone interact with this? Do they just review and say that more likely this is versus more likely that? Or do you have to actually like checklist through them?
You would go through these, and if you felt like a majority of them were leaning toward an employee rather than an independent contractor. Let's say you got a 1099 NEC. You weren't expecting that. Let's say you were working as a receptionist somewhere, and you're working 9 to 5, 5 days a week with an hour lunch, and so you're working 40 hours a week, and at the end of the year, you get a 1099. You say, well, I don't know what this is. I've never seen a 1099 before in my life. So you come to me and I help prepare your taxes, and then I start asking these questions like, you know, are you using their equipment? Are you, like I might hire someone as like a phone answering agent, and that really could be an independent contractor, especially, you know, there are services that will do that for you, like when your business is closed, they'll forward the phones to them and they'll act as like an independent receptionist.
After hours.
Yeah. But if you show up to work during regular business hours, 40 hours a week, you're being paid $15 an hour, and all of that, we ask these questions and we would say, well, it sounds like you're an employee. You shouldn't have gotten a 1099. Like you're using the business's equipment, using their phone system. They're telling you when to show up, when to leave, all of this stuff. So then, if you're an employee and you get a 1099, you can use this Form 8919 to pay only the employee's share of Social Security and Medicare tax. You still have to pay that tax because it didn't come out of your paycheck like it said it's supposed to. But at least you don't have to pay both halves of the tax.
So then you would simply fill out the form, pay your half?
Yeah, you would need 8919 and an SS8. SS8 is like a 5-page questionnaire where you ask the IRS to determine whether you were supposed to be an employee or a contractor.
And then,
So
if you got it from there, you're not working at that place anymore, then you don't have to go back and interact with that business.
Correct. Yeah.
You simply fill
If you file an SS8, the IRS will also ask the other party to fill out an SS8 to get their, you know, both sides of the story, and then come up with a determination at the end.
If a business was deemed to classify someone as an independent contractor where they should have been an employee, are they just going to ask them to pay the other half?
Yep, they're gonna tell them to file a 941,
Hi, bye.
or they're gonna adjust the employer's 941 to make them pay the employer's share of Social Security and Medicare tax.
What was the name of the other form?
One of the forms was an SS8. That's the questionnaire. And the 8919 is the form where you calculate the employee share of Social Security and Medicare tax. A lot of these questions you might ask ahead of time to determine whether you should be giving the people who work for you W-2s or 1099s. Or you might sit down with a tax planner like me, saying, should I be doing payroll for these people, or am I okay to give them 1099s? Then we would ask these questions. And if it seems like, yeah, they should be your employees, well, then I'm not gonna do your payroll for you, but I'm gonna refer you to someone who can help you do payroll. But we see this quite a bit, where they just don't know how to do payroll. It's pretty complicated doing payroll, so they just, take the lazy way out and just give them a 1099.
And then you get audited by the state of Alaska, and then you gotta pay it back.
Oh, yeah, if someone's your employee, you also gotta pay unemployment tax. So another thing that might happen is if someone should have been your employee and you're paying them as an independent contractor, and then they lose their job, they file for unemployment, and it turns out, well, if you're self-employed, you don't qualify for unemployment. So they may complain to the state of Alaska saying, I wasn't an independent contractor, I was an employee, and so you may also get audited by the state.
If you're self-employed and you've business goes under or whatever, you can't even get self-employment or
No.
unemployment?
No, you don't pay unemployment tax on self-employment income, so you don't get unemployment benefits when that income stops.
What if you had a partnership?
Same thing.
Same as an S corp?
An S corp is allowed to opt into their shareholder, owner, employees being covered by unemployment. So that's optional if it's a S corp or C corp. But a partnership, no, you're never an employee of your partnership. And since if you're not an employee, you're not covered by unemployment.
So what if, there's situations like where you just don't have work for 6 months, or the market conditions change or other stuff, you've got no possible,
You didn't pay into unemployment, so you don't.
can someone choose to pay into it?
Only if you're a corporation. That's what I'm saying. If you're a corporation, your shareholder, owner, employees can elect to be covered for unemployment. But a sole proprietor or a partnership cannot opt into unemployment tax. Okay, so all of those previous 3 screens were all about how to tell the difference between a employee and an independent contractor. That's important. And then secondly, we also need to be able to distinguish the difference between a hobby or a business. And a hobby, even though you might make money at your hobby, you don't pay self-employment tax and you don't get to deduct any of your expenses. A business, you get a full deduction for all of your expenses, but you have to pay self-employment tax on your net profit. So it's not really a choice, but if you were able to choose, sometimes a business would be better and a hobby would be better. Hobby is also not considered earned income for any tax purpose that requires earned income. Okay. So here are about 10 or 12 factors that help us decide whether an activity is a hobby or a business.
Well, you mentioned for hobbies, they can't deduct their expenses.
Correct.
Does that include their cost of goods sold or just all the other expenses?
Well, cost of goods sold is not really a deduction, it's just not income, because the definition of gross income includes only the gains on property transactions. So if you buy something for $10 and sell it for $12, you earned $2. It's not technically a deduction. So yes, cost of goods sold would be factored in there.
Okay.
Okay, so the whole question of whether something is a hobby or a business has to do with your profit motive. And hobby, this is kind of maybe a misleading term. That indicates anything where you happen to make money, but money was not your goal. So it's not really a hobby. I had a school teacher who volunteered to proctor at like SAT and ACT tests, and they get paid a little bit of money, but that wasn't like their goal. They didn't really care about the money. I mean, the money's nice, but they would have done it for free if it was available. So that's really not a hobby. I mean, they weren't doing it for fun, but they had no profit motive. The money was not the goal there. So the question is money the goal? So an example of a hobby might be like you enjoy knitting, and every once in a while, so you post your stuff on Facebook, and every once in a while someone will say, hey, can I buy some of your stuff? You say, okay, and you take some money and you send it off. But it costs you, you spend a lot more on your hobby than you ever make on it. So that, whatever you made on that would be income. but you wouldn't get to deduct any of your expenses. You could probably count some cost of goods sold, like how much actual yarn went into this sweater that you just sold, or knit cap, or whatever. But you wouldn't be able to take like your normal expenses, like equipment or supplies and things like that. Business use of home. So besides these factors, which we'll go over, one question that I like to ask, which really cuts to the heart of the situation, is, especially when people are losing money, is if you were 100% certain that you will never make money doing this, would you keep doing it? And if the answer is yes, it's probably a hobby. And if the answer is no, I'm trying to make money out of it, then it's more likely to be a business. Okay. So some of these factors, the website actually lies and says the IRS has established these factors. Actually, these factors were established by courts. The IRS is trying to take ownership of that. So first factor is whether you carry out your activity in a business-like manner and you're maintaining complete and accurate books. The more effort you put into keeping track of what you're doing, the more likely it is to be a business. Let's see, whether you put enough time and effort into the activity to show that you have an intent to make it profitable. Whether you actually depend on that income for your livelihood. So if you have a job that you make $250,000 a year at your job, and then you have this side thing going on where you make, maybe you make $100 every other week, you're not really relying on that money, so it's more likely to be a hobby. Let's see, whether you have any personal, like recreational motives for carrying out the activity. Let's say we have had people that are like vacation guides or something, like they'll go on a trip and they'll make sure to take lots of pictures and videos, and they upload it to like some kind of website that packages that and creates like a tour guide video. And they make some money off of that. But, being able to go on vacation for 2 or 3 weeks is a pretty good fringe benefit. So is it really, are you in it for the money, or are you in it to, help reduce the cost of going on vacation 3 weeks a year, or 3 weeks every 3 months? I don't know, especially if you have another job that pays you pretty well. Do you have enough income from other sources to fund that activity? So like if the business is self-sustaining, it's more likely to be a business, but if you have to keep putting more money into it, it's more likely to be a hobby. If you're losing money, is it because of circumstances beyond your control? Or is that a normal thing for your line of business? Like a new restaurant typically doesn't make money in their first 2 to 6 years of being open. It takes a while to build up the clientele and all of that. Or was it beyond your control because a windstorm came and tore your roof off, and so you lost money that year? If you're losing money, or even if you're not losing money, are you improving your methods? Are you showing that you are studying and figuring out how to make your business more profitable? Or if you're losing money, are you working to make it not that you're getting losses, that you're starting to make a profit? The taxpayer and maybe other people, your consultants or other advisors, actually know how to run that kind of business. Have you had success in making a profit in that same business in the past? Do you actually have a profit every once in a while. And finally, even if you're year to year, even if you're losing money each year, but you expect the assets that you use in that activity to be worth more when you're done with them than they were when you purchased them, then that could make your activity a business. This was actually, I heard of a court case where some people were working a farm and they're losing money every year on their farm. But the tax court let them claim that as a business because because the land that they were working, they expected that to be worth a lot more sometime in the near future, because there were plans to for the city to annex their farm, and and to move, so they'd be able to sell their farmland for a lot more as like commercial or residential land rather than farmland. So since they're stuck waiting for that anyway, they might as well work the land and make a little bit of money off of it, even though they are still losing money each year. So those are all the factors, and basically each one of these points down to, are you trying to make money? And the reason this is important is because if you file a self-employment Schedule C with losses, the IRS can say, you were never intending to make money off of that. We're gonna zero out your Schedule C, not let you count those losses.
So the biggest effect of the hobby versus business is if you have losses.
Mm-hmm.
Because if you don't have losses and you have some income from it, the net effect between the two isn't that different, right?
Right. Yeah, so I did have a client, I didn't do their taxes, but they wanted me to help them with the situation they had gotten themselves into. They had this Schedule C with $100,000 loss for 5 years running. And then they got audited by the IRS, and the IRS says, no, we're not going to allow this loss. And so they took away their $100,000 deduction, and they ended up owing a few $100,000 in taxes, because this was multiple years going on. What they needed my help with was to help do an offer and compromise, but that's a completely separate issue. But yes, if you are losing money year after year after year, you really have to sit down and think, is this really a business? And if I tell you, if you lose money 5 years in a row, if you're losing less money each year, you're approaching profitability, it's more likely to be in business. So I might start up a business and I lose $50,000 my first year. In my second year I lose $30,000. My third year I lose $10,000. I'm doing better. I'm still not doing great. I'm still losing money every year, but I'm losing less each year. And if I keep on that course, I'll start making money in the future. That's something you could argue to the IRS, saying, I'm becoming less of a loss. I'm improving, my ability to make a profit, and I anticipate, after another 3 years, I'll have made all my money back, and then I'll start making a profit and paying taxes.
So for me, like the business I'm gonna start, I know for the first couple of years I'm gonna have to keep buying more equipment until I have everything I need. So I would have a loss for those years, and then it would get a profit.
Yeah, it's fairly typical, and there is a box you can check on Schedule C that says, yes, I just started this business. And that notifies the IRS that you're not going to expect to make a profit in the first at least 2 to 3 years. But as long as you're, have a reasonable expectation of a profit and a reasonable profit motive, it all comes down to profit motive. then it's more likely to be a business.
And the biggest difference becomes whether you can deduct the losses and whether you can deduct overhead and such, right? It's a hobby and you got $500 worth, but you can't deduct some of the overhead costs.
Right. So I might, so someone who was, the example I gave of someone who just knits as a hobby and happens to have casual sales of $1,000 for the year, but spends $15,000 on yarn and needles and all this other stuff, that's going to be a hobby. Because how are you expecting to make money if you're giving, they probably give away more than they sell. How are you expecting to make money if you keep giving your stuff away? You don't even have a website, you're not advertising, you're not keeping all your receipts. That's going to be a hobby. But if you're really going after it, and if you have an Etsy page and a website and you're active on Facebook and other social media, and you're advertising, you're going to trade shows or these carnivals and bazaars around town, and you're really trying to make money at it, then it could be a business even if you're losing money.
Okay. Has there been instances of the hobby versus business, even for people who have gross $100,000 a year in sales?
No, if you are in fact profitable, the IRS is going to assume that it's a business. So we'll get to.
I guess what I mean is they have a higher dollar amount of sales, but they are not profitable.
Yeah. If you have pretty high sales, but you're still losing money, it might still be considered a hobby if if you're not trying to improve on that. So if you have 100,000 in sales and $150,000 in expenses, and you're satisfied with that, then there's no profit motive. If you have this loss, you should be pretty upset that you have a loss if you have a profit motive. So every year you have 100,000 in sales and $150,000 in expenses, and this is year after year after year. Pretty soon the IRS and probably your family and your friends and your tax preparer are all going to say, if you're losing money every year, why do you keep doing this? Why don't you quit if you lose money every year? And that could actually be help determine that you were a business. You'd say, I tried this business, I lost money 4 years in a row, so I quit. I got a regular job, and that could demonstrate your profit motive. But if you're going to keep doing this, and for 20 years in a row you lose $50,000 a year, then the IRS and most tax preparers are going to say, you never intended to make money, so we're not going to let you take your deductions.
I see. This seems like the biggest factors when you're operating at a loss.
Yeah. The only factor is, are you in it for the money? Do you have a profit motive?
So if you do have a profit, it's very easy to sell that you're a business, but if you're operating at a loss, then it's harder to sell the fact that it's a business.
Right. If you have a loss, you want to deduct that loss so you pay less taxes, which means you're going to be arguing that yes, I'm a business even though I lost money, and then you're going to have to overcome the presumption that you're not in it for the money. On the other hand, if you're making money at something, you may want to try to argue that it's a hobby and not a business because you don't want to pay self-employment tax. The example I gave was a school teacher who proctored for some SAT and ACT exams. They weren't in it for the money, but they did have a profit. They have a profit every year of about $1,000. but they're not really in it for the money, so they could argue, and I argue on their behalf, that it's not a business. They shouldn't have to pay the self-employment tax on this extra $1,000.
At that point, it gets treated almost like a PFD, right? It's other
Yeah,
income.
it's just other income subject to just regular tax. Okay. So, what is self-employment? Self-employment, after we've answered those questions, if you carry on a business or a trade as a sole proprietor or an independent contractor, these are the same thing. This is literally a synonym of this. Sole proprietor and independent contractor mean the same thing. I might ask people, they might not have a business license. IRS doesn't care if you have a business license. If you're trying to make money at something, then it's a business. As long as, if you're not an employee.
So, for me, I'm not starting my business till next year,
Mhm.
but I got equipment and stuff this year. Do I need to do business taxes for that?
No, because your business hasn't started.
Okay,
So once you start making money, then you'll start your business tax.
okay.
But you can't deduct any of your stuff until you actually open
Right.
the business, right?
Mhm.
Because it's not been placed into service. You
Right.
can buy it in
I'm
advance.
totally cool with that.
But then, even if you buy it like 2 years prior, before you start the business, you can then deduct those things that you enter into the business use.
Yeah, and that'll be, we'll get into more detail on that in chapter 13 when we talk about depreciation. So right now, we're kind of just talking about ongoing businesses that already exist. There's different rules for the startup, the first year of a business, or before the first year of a business. So if you're a sole proprietor, independent contractor, doesn't matter, you don't need a business license. Well, legally you need a business license. Like the state of Alaska, or the city of Wasilla, or the Matsu Borough may be mad at you if you don't have a business license. But the IRS doesn't care, they just want their taxes. They don't care if you're paying your state taxes or your state license fees or anything like that. And you're also considered self-employed if you are operating a business as a member of a partnership. Although we won't talk about in any detail on how partnership taxes work, it's still considered self-employment income. A partnership files a different tax return called a Form 1065, and you'll get a K-1 that tells you what your share of income is from that. Okay, so as we discussed before, an activity qualifies for a business if your primary purpose is to make money. You know, if you do something for fun and you happen to get some money out of it once in a while, that's not a business. So you have, your primary purpose is to make money, and you are involved in that activity with continuity and regularity. That means you actually devote some time to it. It doesn't have to be like every day, doesn't even have to be every weekend, but maybe at least every other weekend. So it can be a sideline business. Maybe you just pick it up over the summers if you're maybe a school teacher, so you have a lot of time off over the summers. So you pick up your business over the summer and deal with your school work during the school year. That's one example. And if you don't have any partners and you're not incorporated, then it's a sole proprietor. Let me mention real quick about a lot of people, when we're doing their taxes, I have to ask them, like, how is their business organized? Are you a sole proprietor? Are you a partnership? or a corporation. And at least half of those people will respond, and they will say, well, I'm none of those, I'm an LLC. That's short for limited liability company, and that is something that's been created by state law. So you're an LLC for state purposes, but for federal tax purposes, there is no such thing as an LLC. There is only sole proprietor. There is partnership. There is S corporation. There's a C corporation, and sometimes there's businesses operate as trusts. That's pretty rare. So these four are the main ways businesses are organized. And LLC is not one of these categories. So LLC does not exist for tax purposes. So if you're organized as an LLC, then if you don't do anything else, you file your LLC paperwork with the state and that's it, you don't do anything special, then if you're a single member LLC, that's what SM stands for, single member LLC, then you're a sole proprietor for tax purposes.
What happens if someone opens an LLC with partners, or they think they're going into it with, you know, family or partners, and then there's no activity from the others, and then they have to redo it as a, try to take them off the LLC, and then redo it as a sole proper, just be like a single member LLC at that point, you know, keep the name, but do they still have to do paperwork for the original where there was an activity from the original partners? If, you know, they just fell through, like they created the LLC but then they kind of walked away or something of that nature?
Probably not. I mean, they could they could file a report, a change of ownership report with the state to take those other people's names off.
Okay.
If you have a multiple member LLC, then by default you're a partnership. And I guess in that case, if you organize a multiple member LLC and then nothing happens, partnerships file Form 1065, and the filing requirement for a partnership, so like a 1040, you only have to file a 1040 if you have at least 12,950 or whatever your standard deduction is for income, or if your self-employment income, net income is at least 400. Partnerships filing requirement is $1. If they have $1 in income or $1 in expenses, they're required to file a return. So in this case that you're talking about, where you've created a multi-member LLC and then nothing happens, there's no income, no expenses, that partnership's not required to file a tax return. And then you reorganize as a single member LLC, then a sole proprietor will go on your tax return as a Schedule C.
What if the reorganization happens in the next year, or, you know, they
Well,
made a
if
few
there's
bucks?
no income, no expenses, if there's any income and any expenses, you have to file a 1065 partnership return. And if there's no income and no expenses, then just forget about it. Then don't worry about filing a partnership return. Okay. So sole proprietor, also a single member LLC, files Schedule C as part of their 1040. A multiple member LLC will file Form 1065. And it produces a K-1, which goes out to each of the partners. So partnerships do not pay taxes, but they file tax returns. And each partner pays taxes on their share of the income. And that is true even if they don't collect any of that income. So if all the money stays in the business, each partner still has to pay taxes on their share, proportional share of the income.
What about in my example of someone that like has to restructure because, you know, say there's 3 people and then one person does all the work and the other 2, you know, they signed up and then they don't do anything. When it comes time, can they allocate all that income to one partner
Partners can, yes.
and then no income to the others?
Yes, but it all depends on, an LLC should have, and actually legally must have, but many of them kind of ignore this requirement, but an LLC should have an operating agreement. So, if you start up a multi-member LLC and you end up doing all the work and your other partners, the other members, they're considered members, not partners, the other members don't do any work, and so you keep all the profit for yourself, well, does your operating agreement provide for that situation? If it does, then you can do whatever the operating agreement says. But if you say, well, I did all the work, so I'm going to keep all the profit for myself, even if your organization paperwork says we're equal 33% partners each. If your operating agreement doesn't say that, then those partners could come back and sue you and say, well, we want our third of the profit. Whether they're going to win or not, that's up to the courts. But, you know, you should have this operating agreement that says, you know, whichever partner does the work, they're going to get paid for their work before the profits are split, or something like that. That's something you could do in your operating agreement. But you should really sit down, and attorneys will draft these up for not very expensive, and sit down and say, you know, what could go wrong? You know, how could one person abuse the other people's good faith, and what are the remedies there? It's basically what lawyers, transactional attorneys at least, that's their job, is to see what could go wrong and what's the remedy, like how do we fix it? Instead of don't have to go to court, we just say, oh, this is the rules, this is what we agreed to. If you don't work, you don't get any of the profit. And we'll write that down in our agreement. So questions like that are not tax questions, really, they're legal questions, and those are questions you should ask before you go into business with someone. So if the 4 of us wanted to start up a company, and it turns out Mercedes did all the work and the rest of us are just spending the money out of the bank account, what's the result? What should be the result? Well, we should have thought of that ahead of time. And it's not necessarily Mercedes is doing the work, maybe it's Dimitri's doing all the work. But what happens if someone is taking advantage, unfair advantage? Then we have some idea of what should happen. Okay. So this is the default for an LLC, but an LLC can choose to be treated as an S corporation or a C corporation. Or if you can actually create a corporation with the state of Alaska. So that's a little more complex than creating an LLC, but really not that much more complex. You can create a corporation, or you can be an LLC choosing to be taxed as a corporation. So an S corporation and C corporation are both types of corporations. An S corporation, the S stands for Small Business Corporation. And this is either a corporation or an LLC that has filed a Form 2553, which is your choice. Let me double check that form number. Yeah, election by small business corporation. Okay, an S corporation has filed a Form 2553, And there's a difference between these two is in these two cases, your owners are never employees. Whether it's a sole proprietor partnership or a single member or multi-member LLC that has not elected for corporate tax treatment. Your owners are never employees. You can't go off and write yourself a paycheck and have that and try to have that be treated as actual wages. For corporations, it's exactly the opposite. Owners, if they're working, you could have owners that do nothing and they're just taking their share of the profit. But owners who work must be treated as employees.
So could you start a partnership and then turn it into S Corp or C Corp later?
Yes. Yeah, and the due date of this 2553, for example, so if you're a partnership and you want to be treated as an S Corp, the due date of this is the third month of the year where the election is going to be effective. So if you want to start being an S Corp in 2024,
File it by March.
you have to file by March 2024. By the time it comes around time to do your taxes, it's too late. You're too late already by a whole year. So this is something you have to do ahead of time. There are ways around it if you didn't know about that deadline. So these, because the owners are never employees, these are both considered self-employment activities, and these are not considered self-employment activities. So your S Corp files a 2553 and it pays you a wage. And it could be that your, or C Corp, you own your C Corp, maybe you're the sole owner of a C Corp, but it still pays you a wage if you're doing any work for it. And in both of these cases, you have to pay yourself what's called a reasonable wage or salary, which is, which there's a lot of gray area there on what is a reasonable wage or salary, but the basic idea is, what would you pay someone to replace you? If you wanted to be a completely passive owner and stop working in your company, and you wanted someone else to do that, what would you pay them? And you still presumably would have some profit that you get to keep from having built up the company from scratch. But what would you pay someone to take over all of your duties? Or equivalently, what would someone have to pay you to make you stop doing what you're doing?
What does that mean? Pay you to stop doing what you're doing?
So let's say you own a let's say you own a company, let's say residential construction, so you make some money and somebody says, hey, why don't you leave your company and come work for me? How much would I have to pay you to do that? That would be reasonable compensation. And you might still have your company running and you would run it but not actually work in it. But I say, leave your company, come work for me. How much would I have to pay you to do that?
So a third party is paying you to leave.
How much is your labor actually worth to the company? There's two ways to measure that. How much is your labor actually worth to the company? The one way to measure that would be how much would it take to hire someone to completely replace you. Now you have no duties whatsoever. You're just going to live on the beach from now on and collect your profits. How much you're going to pay that other person to do what you did.
Yeah, that makes
Which
sense.
is equivalent to how much would it take to take you away from the company. Those should both be equivalent.
Gotcha. When the descriptive on the other way, when a third party is paying you to leave, it's hard to, visualize.
Right, I mean, your company is still going to exist. We're not telling you to shut down your company. We're just saying, you know, what would it cost, what would it cost to make you quit your job and, you know, put someone else in there instead as the general manager? Okay, so
just so I understand it correctly, the second one around, you're saying, what would it cost to get you to leave?
mhm.
Is when someone's asking, what are you worth?
Mhm.
Then that would be a reasonable way to, I guess,
Yeah.
value that.
What would it cost to replace you? Basically, there's two ways of thinking about it. Like, what would it cost to replace
So if you have to justify why you're taking $500,000 out of your business every year,
you?
you're saying because that's what it takes
yeah.
for me to leave.
Well, it could be, okay, it could be your business is generating $500,000 and you have a $200,000 salary, so it's generating excess $300,000. But that could just be because the business is running on its own, you know. You don't really need to be there. It's still gonna make the $500,000. You're just, you know, if you left it alone, it would still generate some money without your expert guidance. Or maybe you would need to hire a different CEO to help run that company. But there's still some profit above and beyond what the management, you know, the value of the management is.
Okay.
And so you would still have that profit. So you can say, you know, I'm running my construction business and I have a bunch of good employees, you know, everything's running pretty smoothly. I've got people who know how to write bids. I know people who know how to find subcontractors. You know, everything's pretty well in place, you know, but I'm still operating it. You know, I get to choose what to bid on or whatever. But somebody says, hey, why don't you come, you know, work in my company as a manager, or maybe even a completely different industry. I say, well, yeah, I could do that. You know, I expect my business to be able to run itself. But what would it cost you to pry me away from that company? This company might still run on its own and make $300,000. So what would it be worth to me to give up operating that company?
So is it more like opportunity cost of what you're letting go?
Yeah, it's a little bit like opportunity cost.
And that's just for the S Corp and the C Corp, right?
Yes, S Corp and C Corp. So you have to figure out, this is a question of reasonable compensation.
So if you start in S Corp and you guys have like not a whole lot in the bank or whatever, would it be logical to pay each person $20 an hour until you guys have built up?
Yeah, your reasonable compensation, if the business is not profitable, the reasonable compensation could be zero. If you're not getting any money, if the business is not generating any money to pay yourself, you're not required to pay yourself. You don't, business owners aren't required to pay themselves a minimum wage, for example. So you could say, yeah, I'm losing money, so I can't afford to take a salary. And that could be a reasonable compensation. So you would never find someone off the street that would say, oh yeah, I want to come work for you for free. But that could be a reasonable compensation.
If in future years they do make money, do their losses from previous years where they chose to not take any salary offset future?
Well, what the IRS is basically with this rule is what they're trying to get at is that you're not trying to dodge all of your employment tax. So if these following three things are true, if your business is profitable, you have a corporation. Whether it's an S Corp or a C Corp. If it's profitable, and, so I guess only two things, and you get money out of it, then you have to have a reasonable salary.
So you can just, like, for instance, if I left my tree business to go charter a fishing boat or something, I put somebody in charge of my company.
Okay, so there are three things. So if it's profitable, you get money and you do some work in it. So if you're completely a passive investor, if you're a passive business owner, then you don't have to pay yourself a salary. But if it's profitable and you do some work in it and you get some money out of it, then then part of that distribution should be treated as salary.
Okay, now, if they were to make, say, $500,000 a year, it would cost $70,000 to put somebody in my spot of that business. So if I get myself $100,000 a year salary, would that be too much?
No, that could be reasonable.
But if I were to give myself a $400,000 a year salary, that would be too much.
Right. And well, the incentives to you are opposite in both of these cases, because if you're an S corp, you want to avoid paying payroll taxes on yourself. So your incentive, the incentive is to pay yourself as little as possible. And if you're a C corp, you want to avoid double taxation, because corporations, C corps, pay their shareholders in the form of dividends, and the dividends are taxable. The corporation pays its own tax, and the dividends are taxable again. So in this case, the incentive is to pay yourself as much as possible in order to avoid being taxed twice. But in any case, in both of these cases, the IRS does occasionally audit people for reasonable compensation issues. If you have an S corp and you never pay yourself a W-2 and the S corp is profitable, the IRS is going to come back and say, you know, all this money you've taken out of your company, we think $70,000 a year of that should be wages. Which you should have done your own due diligence ahead of time and said, if you had said $40,000 a year, the IRS probably wouldn't dispute that. The IRS is going to come in, they're going to come in with a high number, and they're going to make that stick. But if you start off, even if it's low, below industry average, the IRS probably isn't going to bother with that, as long as you have some sort of wages.
S corp, generally speaking, you're trying to do the minimum salary so that the majority of it can be business earnings as opposed to earned income.
Right, because an S corp pays its owners in two different streams, or it is taxed in two different streams. Part of it goes on a W-2 as wages, and the other part goes to a 1060, or not a 1065, an 1120S K1. This W-2 tells you how much your wages were, just like working for anybody else. And the 1120S K1 tells you what your share of the business profit was. On your wages, you pay Social Security and Medicare tax, and the company also pays Social Security and Medicare tax. But on the earnings, you pay only regular income tax.
Generally speaking, is it more beneficial for someone to be an S corp compared to a partnership LLC? Or
people ask this all the time, and it varies from situation to situation. But a general guideline is, unless your pure profit is more than double what you would pay yourself as an employee, it's generally not worth it to reorganize as an S corp.
Say that again. Unless your pure profit.
Yeah.
Is double
So let's say
salary.
your business makes $80,000 a year, and it was a sole proprietor. Your business is making $80,000 a year as a sole proprietor, and unless you could reasonably guess that only a third of that was, wages equivalent. So if you could get away with paying yourself $25,000 and treating the other 2/3 as profit, it's probably not worthwhile.
Because pretty much all you're saving is your self-employment taxes.
Right, you're saving self-employment tax, and you're also going to get a smaller qualified business income deduction, which we haven't talked about yet.
Smaller as an S corp or smaller as the?
So as an S corp, it'll be smaller.
The S corp would pay unemployment though, right? On the W-2?
It would pay regular payroll taxes.
Right, so
So,
unemployment.
It would not pay state unemployment unless, you elected to be treated as covered for unemployment purposes. The unemployment regulations in Alaska say that if you're more than a 2% owner in a company, you're not required to pay unemployment tax for that employee. But the company can elect to treat all of its 2% owners as covered by unemployment tax or not. So it's not per person, but it's per company.
Right, so like my company I do most of my work in the summer, not much in the winter. So I would elect to do the unemployment tax, so I could collect unemployment when I wasn't working, right?
You would have to actually, I think you would have to actually organize as a corporation, not
Yeah.
just an LLC.
Yeah.
Not to mention if you're worried about getting hurt and getting unemployment, then you pretty much have to organize as an S corp, right?
Yeah.
Because otherwise you can't have unemployment insurance or
Mhm.
workers' comp. Well, workers' comp maybe, but I know usually workers' comp, if you're an owner, you're exempt,
Yeah.
especially
Right.
with wages or.
Well,
deposits.
business owners, take a lot of their own risks. Let's see, and then, a C corp, if you're organized as a corporation and you do nothing, you're a C corp. So a C corp could be an S corp by filing a 2553, or either one of these LLCs could file a 2553 to be treated as an S corp. A C corp, if you organize as a corporation and do nothing else, you're a C corp. But if you're an LLC, you could file an 8832. But a C corp doesn't file an 8832. This is only LLCs are treated as C corps. And a C corp again pays its owners, if they're owner employees, they still pay a W-2. And this is the only one of all of these that pays its own taxes.
So what is the 8832 again?
This is if you're an LLC and you elect to be treated as a C corporation.
I know that was the individual tax significantly higher in the early or mid 2000s? I was interning at a
Yes.
real estate company, and I know that they were talking about that one of the guys, I guess he had a lot of sales, and they elected to basically be a C corp personally for his real estate stuff, his broker, realtor.
Yeah, the top tax rate during the Clinton administration was 39.6%. A C corporation pays its own tax. It files a form 1120 without the S this time. And right now, the corporate tax rate is a flat 21% of net profit. Before 2018, it was a graduated rate, so you could pay 10% or 15%, all the way up to a maximum of 35%. But now it's just flat 21%. Besides a W-2, to pay its owners, it can also issue dividends. So this is the other way its owners get paid, is through with a 1099 DIV, which is the same 1099 DIV you get from a brokerage or any other corporation. So if you're an owner of Coca-Cola or Google or Microsoft, you're getting dividends from them. It's the same dividends that you would pay yourself as maybe a small corporation shareholder.
So if you had a corporate tax, your business was a C corp, and you were, say, a single member, C corp in a way, you have a 21% tax rate, and then anything beyond that would be simply a combination of, well, actually, that'd be after the W-2, because they'd be claiming you as a W-2. So you get your W-2, the corporation pays 21% on their net, and then anything left over for the year, or at that point, it's any additional portion.
Any money that's left over has to stay in the corporation unless you issue dividends. So if you take money out, you cannot take money out of the corporation without counting it as either dividends or wages.
Okay, so it's one or the other.
Yeah.
Okay, so at that point, if you want additional disbursements beyond the W-2, then you issue a dividend to yourself in a way,
Right.
and that gets taxed at whichever normal investment income
Yeah.
rate.
Yeah. 0, 15, or 20%, depending on your tax bracket. Okay, so this section where owners are never employees, sole proprietors, and partnerships, these are both subject to self-employment tax. And that's one reason you don't issue W-2s to yourself, because you're considered working for yourself. And we're actually going to ignore the trust because that's pretty rare. But you can have a business trust. But I haven't dealt with any, so don't worry about it. And anything that's treated as a corporation, there is no self-employment tax. Which is why the W-2 is required if you're working and you have a profit and you have distributions. So again, sole proprietors and partnerships are never employees, and for S corporations and C corporations, anybody who works for them are always employees.
So wait, the S corp, you get your W-2, and then what happens to the remainder of the profits?
You can do whatever you want with it. You can leave it in a company or you can take it out, but you have to pay taxes on your share because S corps do not pay their own taxes.
So at that point, you're getting taxed on the full amount whether you pull it out or not.
Right.
And then what happens if later you want to pull it out and it's just retained earnings that you're pulling out of it?
Then you can do that because it's already been taxed. You can take out money out of your S corporation that's already been taxed. So you have a basis in your S corporation. With both of these partnerships and S corporations, your basis goes up and down every year.
Okay.
As you pay taxes on the income and you take already taxed money out.
So, say someone has a tax year where they've got, the business made $100,000 in that tax year, but they've got $1 million of like retained earnings or basis in it. If they choose to pull that whole $100,000 out that year, are they still taxed on it in some way?
No. You can take, as long as your distributions do not, from an S corporation or partnership, are less than your basis, none of it is taxed.
Even if the business in a way, you know, that $100,000 they brought in was a business activity that you would think would be taxed.
It's taxed when it's earned, not when it's distributed. So if I have this business and it makes $20,000 in a year for 5 years, I'm paying tax on that, whether I leave it there or not. So I can just leave it there, and in year 6 I can take the whole $100,000 out. I don't pay taxes on it again.
But as you earn it, you have to do your quarterly taxes and pay for the tax on that.
Well, it's still an annual tax.
Okay, so that, where you've got $1 million basis and in 1 year you've got 100,000 of earnings
Mhm.
on the business.
You pay taxes on the $100,000 earnings.
Whether you leave it or take it out, you're
Yeah.
still paying on that full amount. It isn't,
Mhm.
there's no way to avoid the taxes by calling it your basis that you're pulling out or anything like that.
Right.
Okay.
So if I own an S corporation, it makes $100,000, I pay taxes on $100,000, regardless of what I do with that. If I leave it in the S corporation, if I take 100,000 out, or if I take 50% of that out, or if I take more than 100,000 out, it doesn't matter, I pay taxes on $100,000.
I see, okay. Because I guess at some point I thought I came across info where it seemed as if you were just pulling money out, or selling equipment and pulling out, or in some way, you're pulling retained earnings out of it, that it's not taxable.
Right, it's, well, it's not, let's see, if you're taking basis out, so don't think about retained earnings, but think about basis. If you're taking basis out, it's already been taxed, you're not gonna be taxed on it again. But you have to pay taxes every year on the earnings, regardless, because an S corporation does not pay tax. So an S corporation does not pay tax. Its owners pay tax. So if you own, let's say the four of us went to business together and we formed an S corporation, even if I was the sole employee and the corporation earned $100,000, all of you would pay tax on $25,000, your share, regardless of whether the company kept the money, to help finance its operations and grow, or if it gave the money out. Doesn't matter. You pay the same tax regardless.
So I guess it's most visible when you don't have any earnings and you pull money out, that it's really clear that it's a non-taxable event. I guess.
Right, you're getting and as long as you have basis. And for S corps and partnerships, your basis changes every year. So for S corps and partnerships, you have, you're going to have your basis at the beginning of the year. BOY stands for beginning of the year. You're going to add to that basis any money that you put in. So this will be contributions. You're going to add any taxable earnings. And then you're going to subtract any distributions. And you also subtract any losses. And then this total becomes your basis at the end of the year. So you have to keep track of your basis every year. So even if you don't put any money in or take any money out, your basis will change every year.
And then the end of year basis should be the beginning of year basis.
Right. Yeah, this will be your beginning of the year basis the following year. So it's important to track if you're a member of a partnership or an owner of an S corp, you have to keep track of your basis every year. Because the amount that you're taxed on has nothing to do with the amount of money you actually get.
Is it based on your basis at all, the amount that you're taxed on, or is it based on?
No, it has nothing to do with your basis. Your basis increases by the amount that you're taxed on, the earnings. But you're taxed on specifically your share of the earnings. So if you're a 50% shareholder in an S corporation, you pay half of the S corporation's taxes. Or you pay taxes on half of the earnings, regardless of whether you see any of that money or not. Same thing with a partnership. If you're a 5% member of a partnership, you pay taxes on 5% of that partnership's earnings, even if you don't get any money, or if you get more than that amount of money. The amount of money you get has nothing to do with how much your taxable amount is. The taxable amount is what your share of the income is. Because partnerships and S corporations do not pay tax. Their members or owners pay tax instead.
Okay.
Okay, so we've gotten a long way off of just talking about self-employment. But we have a lot of people who do ask these questions about, should I be an S corporation, should I be a C corporation? Also, one of the reasons not to be an S corporation or a C corporation or a partnership, if you can avoid it, is because you have to file an extra tax return. And typically, those tax returns cost a minimum of $500 if we're doing them. And we are actually a lot cheaper than most companies. If you go to any CPA firm, you probably expect to pay at least $1,200 for.
The tax prep fee for the S corp and stuff would be deductible for the next year on that business, right?
Yes, it's deductible as a business expense. That's correct. But you can expect to pay. Most companies will charge at least $1,200, and $1,200, as far as what I've read on the internet, is considered dirt cheap for an S corporation or a C corporation return. So you actually get a really good deal when we do one for $500 or $600.
But a multi-member LLC partnership does not have to do that?
A multi-member LLC partnership has to file a 1065.
And is that more or less the same thing
Yep,
in terms of process?
minimum $500 for us. Most companies would charge at least $1,200. And that's in addition to your regular filing your 1040. So you have to consider whether your tax savings exceeds the extra costs of doing that additional tax return. And also, if you're an S corporation, since you have to file a W-2, you have to treat yourself as an employee. Now you have to hire a payroll company or figure out how to do payroll for yourself. And that can be another minimum $100 a month. So unless you're expecting to save over $2,000 in taxes, it's probably not worthwhile to organize as an S corp. Okay. Okay, so these are different ideas, different types of self-employment income. Income from a part-time business, you receive it as a sole proprietor. Income you receive as an independent contractor. These are all synonymous. These all mean the same thing. Let's see. You may have self-employment income from real estate rental if you are either a real estate dealer or you provide significant personal services besides just the rent. So if you're renting and you're also doing their laundry and cooking for them, then that's not really a rental activity anymore. That would be self-employment. That'd be more like a bed and breakfast or a hotel.
But if you have rental property and you mow the lawn and plow the driveway or shovel the driveway,
Yeah, then that's not going to be rental income, or not going to be self-employment income.
it just still counts on your rental schedule.
Yeah. Mm-hmm.
Okay. But at that point, you're probably not deducting your own personal activity in that either.
Mm-hmm. What do you mean?
If you have a rental property and you're doing work that you may pay someone else to do, but you're choosing to do it, then it just counts as additional income for you on the net. But
Yeah,
you can't deduct it.
you'll have more net income because you can't deduct the value of your own services. Let's see. Direct sales is another typical self-employment activity. So whether you're a real estate agent or other direct sales, if you're substantially paid by, it's almost all commission, and not related to the number of hours you work, then that's more likely, that's pretty often self-employment income. Let's see.
But if you're base plus commission, then usually you're probably an employee no matter what, right?
Yeah, if you get an hourly wage plus commission, that's going to be an employee type of arrangement. But if you're solely commission, if you get no wage and you only get commissions, then you're probably an independent contractor.
Are most like automotive salespeople pure commission and just considered 1099?
As far as I know, everybody that I've worked with who is a used car dealer or new car dealer was an employee of the place they worked. So, yeah, but if you, let's see, another typical self-employment activity would be, at least this was the case when I worked in this industry, taxi drivers, and hair stylists, nail technicians are typically self-employed. They get to keep whatever they make, but they have to pay the company they're working at. They're not really working for the company, they're working at the company, and they're paying for the right to use their establishment. So when I was a cab driver, I would pay a flat $85 a day to be a cab driver. And whatever I make, that's what I make.
So they're basically renting out their vehicles for $85
Right.
a day to the drivers, and you guys are covering the fuel and whatever.
Yeah, well, I would also pay for the fuel. So I pay $85 for the car, and I'd have to bring it back fully gassed up. I'd check it out fully gassed and bring it back fully gassed. So I'm renting a car for $85. But whatever I happen to make that day is what I made. So that's the opportunity for profit or loss. If I make $50, I just went to work to make negative $35. Cost me money to go to work. But if I make $300, that's a nice day. I just pay my $85 plus $30 in gas, and I still took home $185, which back in the 90s was a fairly decent wage. Maybe not so much now. For 12 hours of work, man, I think my best day was I took home $300 for 12 hours of work. So maybe not so great in today's dollars, but it was pretty good. My first year or two out of college. And let's see. Income passed through to you from a partnership is also considered self-employment income, but that will not show up in Schedule C. Rental income from real estate and personal property rental is not self-employment income. Unless you are a real estate professional, which there's special rules for that. I think one of them is that you spend at least 1,000 hours a year in real estate related activities.
So
Either buying, selling, or working in your rental.
if you had an Airbnb, would that be?
An Airbnb would typically, well, it depends. Depends on what you do besides just lease out your property. If you say, if you just hand over the keys and say, just have fun, and they leave and you collect your money, you don't do anything else, that's going to be this non-self-employment income. But if you're Airbnb and you're renting out like a spare room in your home, and you're like also offering extra services, like you're doing their laundry and cooking for them, making them breakfast, like a traditional B&B would be, then that would be self-employment income.
The whole amount or a portion of it?
The whole amount, yeah. The whole question is, are there significant personal services involved? personal services, meaning like laundry and
Housekeeping stuff.
housekeeping and, yeah. Okay, here are some different forms you may get for self-employment. You may be surprised by one of these, the W-2. You could have self-employment on a W-2. So first of all, 1099 NEC is not employee compensation. That's what the NEC stands for. And this is a new form. It was first issued, was created for the 2020 tax year. People still haven't gotten used to it. So we may still have people occasionally producing incorrect 1099 miscellaneous. So there used to be a box 7 on 1099 miscellaneous that said non-employee compensation, but they took that box out of that and put it into its own form, non-employee compensation. Non-employee compensation is a long way of saying this is money that you're paying someone for the work that they do, but they're not your employee. But there's other, there are valid types of income that go on a 1099 miscellaneous that are self-employment. So a 1099 miscellaneous could also include royalties, which would be if you're a professional author or professional musician or something like that, and somebody's paying you to use your the art that you've created, that would be royalties. And if that is your business, then royalties would be considered self-employment income. And the other two that might show up here, it's actually 3. So the other 3 that might show up here are fishing boat proceeds, and medical and healthcare payments, and there's a couple more. There's a spot for crop insurance proceeds, and there's also proceeds paid to an attorney. So all of these could also be self-employment income. But except for these specific 5 categories, self-employment income might show up on a 1099 NEC.
Is everything that's going to show up on a 1099 MISC going to be taxable, or are there ever things that show up on there that are non-taxable items?
There will often, occasionally be things that show up on a 1099 that are non-taxable. For example, proceeds paid to an attorney might not be taxable depending on the nature of your lawsuit. So if you sue someone for breaking your leg, and you get $150,000 out of that, the other party, if they paid directly to your attorney, is supposed to issue a 1099 for $150,000. It's not up to them to decide whether it's taxable. It's going to be up to the final recipient to decide whether that's taxable. And we already know that proceeds from a lawsuit resulting from a personal injury are non-taxable, but you probably still get a 1099 for that.
So if a business gets sued for someone that slipped and fell and broke their leg, and they end up paying out, say, $100,000, right? Are they able to deduct that as a business expense if a scenario like that happens, or are they not even able to deduct it?
It depends on some of the circumstances. If that would be considered an ordinary and necessary business expense, then yes. So if it was like maybe ordinary negligence and not gross negligence, it would probably be deductible.
Okay.
So maybe they had recently, maybe somebody had come by and knocked a jar of pickles on the floor, and the employees didn't notice it yet, and someone else came by and slipped on it and sued the store and won a settlement. The store is not negligent in any way, and so they would probably be able to deduct that payment. But if, you know, if that floor had been wet and slippery for all day long, and people kept going up to employees saying, hey, you need to fix this, or at least block off that aisle or something, and nothing ever happened, then it would rise to maybe the level of gross negligence or something like that, not be an ordinary business expense anymore. And
Who
then
makes that determination? Would it be a judge usually that classifies it as one or the other, or?
No, that would be an argument between the taxpayer and the IRS. So it may end up going to a judge at the tax court. Yeah, so maybe a judge would have to make that final decision.
Okay. And that still only applies strictly to personal injury, right? Not to other payments or settlements.
Right. It depends on the nature of the lawsuit. So if someone crashed into my car, and you know I wasn't in it, so I'm not injured. Somebody crashed in my car while it was parked, and I sued them and got the value of my car, let's say $10,000. That would probably still get a 1099 if I hired an attorney for that small amount. But it would not be taxable. It'd be treated as if I had sold that car for $10,000.
What if it was just money that you got and then you used to fix your car back up to its
Then-
original condition?
Then it would be treated as a return of basis and then a restoration of basis. So it would be treated as a nothing for tax purposes. So if I got money and then I used that to actually fix my car, it would be zero. None, not taxable. Let's see. We might also get a 1099-K. This is not necessarily self-employment income because a 1099-K could be issued to you if you are a landlord and you get payments through Venmo, or you take credit cards for your for rent. And W-2, surprisingly, because of box 13, is self-employment income. Box 13, if it's checked and says statutory employee, what that means is for Social Security and Medicare tax purposes, you're treated as an employee, but for income tax purposes, you're self-employed, which means you get kind of the best of both worlds. Your money has already been, you've already had your share of Social Security and Medicare tax taken out, and whoever paid you has matched that. But you also get to deduct your expenses for income tax purposes. You're not going to get any refund of your Social Security tax, but at least you get to pay less income tax. And the last thing I'll say is pretty close to 8, and probably is already after 8, is that all of these forms, or at least the 1099 series, 1099 NEC and miscellaneous, are required to be issued by a business. So if you're not a business, it doesn't matter how much you pay or what you pay or who you pay it to, you're not required to file these forms. So if you pay in the course of your business $600 or more, for services, to an unincorporated or people, then you have to file a 1099 miscellaneous. So there's a few sub-clauses there that, so it has to be a business before you're required to file one of these. It has to be 600 or more, has to be services, and has to be paying to an unincorporated person. Oh, there's one more requirement that's new, that's why I forgot it. Excluding credit card payments.
Because those are already shown up elsewhere.
Yeah, because they're going to 1099K. So the IRS doesn't want you to double report these. So if you pay someone through Venmo or a credit card payment or any other kind of payment that's going to show up on a 1099K, you should not also report it on a 1099 NEC.
What if you're an individual that hires someone for basically just help, like with landscaping or something, you're improving your property and you just need
Right.
extra hired hands,
Then that's not a business and you do not issue a 1099.
regardless of how much you might pay throughout the whole year?
Right.
That's
So
all.
if I need to remodel my kitchen or my bathroom and I pay someone, a contractor to help me out, and I pay $6,000 for that, that's not my business. So I do not issue a 1099.
What about in my scenario where in our business, we build homes,
Mhm.
but then I might be building a home for myself, maybe, and I may consider it to be outside the business because I'm doing much of the work myself and whatever, it's not part of the business, but it's similar activity. And I hire
You only issue the 1099 for the payments you make in the course of your business. So
Okay.
even if it's the same person, if you pay someone $5,000 to do framing at a house that you're building, and then you pay the same person $1,000 to help you build a deck, you only issue a 1099 for the 5,000, not the 1,000 that's for your personal project.
So if it's your personal project, you don't really have to issue any 1099s at all.
Right. You don't keep track, you don't issue 1099s. If I hire, so anything that's not business related, you do not issue 1099s.
Okay. But of course, you can't be taking business deductions on any of that because.
Right, because it's not business related.
Okay.
So you only issue 1099s for business related transactions, total of 600 or more per year, for services provided to you. So if you are buying lumber, that's not services, that's goods. So you do not issue a 1099 for stuff that you buy, just for someone doing work for you.
What happens if a business basically has hired extra hands that they need for a day, like a gig, right?
Mm-hmm.
I need help for a day with something.
If it's 600 or more, you have to issue a 1099.
But if it's under 600, then they can just write them a check. They don't need a W-2, all that kind of stuff, or just a
Right.
day labor.
Right. If it's less than 600 in a single year. So if you pay someone $200 for one day of work, and maybe later on in the year you pay them another $200 for another day of work, and then sometime later that same year you pay them another $200, now you have to issue them a 1099 because you've reached the $600 threshold.
But if you stay below it, then as long as you don't get above it, you just give them your checks, or you pay them however you decide to pay them,
Mm-hmm.
and you're not obligated to do any special documentation, right? You just write
Right.
up a check and you're done.
And so $600 for services you pay to an unincorporated person. So that'd be anybody that's self-employed, basically. If they're a corporation, you do not issue 1099s to them. So if you hire, well, this would be services. This is also include like equipment rental. So if you rent equipment from Home Depot is a corporation. You don't have to worry about whether you need a 1099 or not, because it's a corporation. You don't have to worry about that.
So how does it work for like a construction company that hires contractors, and mostly businesses, probably 80% of them are LLCs of the sort.
Mhm.
Are they required to issue them
Well,
1099s? 'Cause
You-
I always thought they were.
you should give them a W-9 to ask them what their EIN is and whether they're a corporation or not. And if they check the box that says corporation, then don't issue them a 1099.
Oh, really?
Yeah.
But if they're an LLC partnership,
Yeah.
then you do?
Right, if they say LLC taxed as a partnership, then you do issue them a 1099.
And when you say corporation in this case, it doesn't matter if it's S Corp or C Corp, you don't need to issue for those?
Right.
Okay.
And technically, if they're an LLC taxed as a corporation, you still need to issue them because they're not technically a corporation.
Okay, so the only ones that are excluded are plain S Corps and plain C Corps.
Yeah, actual corporations.
And
And if
those-
you wanted to do any due diligence, you could look them up in the state of Alaska database to see if they're a corporation or not.
Okay. Does a business who gets a W-9 have to verify
Yes,
to some extent what they receive?
well,
Because it's hard to, because I know we get 1099, we get W-9s from new contractors
mhm.
that we haven't worked with before, and we kind of take the info that they give us as granted pretty much, like that they've given us the correct social or EIN. We don't try and look it up and verify it, generally speaking, unless they provide us documentation at the time.
No, not necessarily, but, when you file these 1099s, IRS may come back and say, oh, this 1099 didn't match this name. So from now on, you have to withhold 22% every time you pay this person. That's the danger, so.
And that primarily is related to individuals that they've had an issue with or where it bounced back, not to your procedure as a whole. Right?
Right.
Okay.
It is optional, you are allowed to, and I believe if you issue more than a certain number, and I think it's 100 1099s, then you are required to verify people's W-9 information. So for small companies that only have a few or a couple dozen contractors, you don't have to worry about verifying people's information. But if you're larger and you have more than a few dozen contractors, you have to verify their information. And if the information doesn't match, so you're supposed to issue this W-9 before you pay them their $600th dollar. So once they, once it's up to $599, you can keep paying them. But once you pay them, if you're going to pay them one more dollar, you should get this W-9 before you pay them that other dollar. Because for a couple of reasons, if it's determined that you are required to verify W-9 information, and again, I don't know for certain, but I think the threshold is 110 1099s. If someone refuses to return that W-9 with their Social Security or EIN on it, you are required now to withhold 22% of whatever you were going to pay them.
Withhold and then send to the IRS?
Yeah, send it to the IRS. And if you're also required to verify that information, if that W-9 and that comes back and that Social Security number doesn't match that name, you're again required to withhold 22%. So one of the dangers is if you don't do this W-9 in a timely manner, IRS might say, well, you should have withheld 22%, so we're going to charge you the 22% anyway, whether you actually withheld it or not. The other danger is you're required to file these 1099s, and if you don't know their Social Security number, these 1099s are going to be incomplete. And it's a penalty of $50 each for each 1099 that you were supposed to file and didn't.
Okay.
And this is a little bit of an urban legend. I'm not sure if this is accurate. I'm pretty sure it's not accurate, but a lot of tax preparers and people on the internet will say that, if you don't issue a 1099, you're not allowed to take a deduction for what you paid. I'm pretty sure that's inaccurate, but
I've heard
there are a
that
few
too.
people that say that.
And at times we've thought that as well.
Yeah.
If we can't, don't 1099, then we can't deduct them.
Yeah, you can deduct it as long as you prove that you paid it, and it was a business purpose for paying it.